Hello, everyone, and thank you very much for joining us today for another webinar in the Ideas for Your ISA series here at Kepler. My name is Joe Litchower, and today we'll be turning to the world of the UK and UK equities specifically. And in just a moment, we'll be hearing from Joe Curtis, a true veteran in that space and the lead manager of the City of London Investment Trust. Now, before I hand over, just a very quick word on how today's session will run. Joe will start with a presentation, around 20 minutes to 30 minutes or so, where he'll walk us through a bit about the trust and share his views on the current market backdrop. And after that, we'll move into a live Q&A session where I'll put some of your questions directly to Joe. So if you do have any questions you want answering, either now or as we go through the presentation, please do just drop them into the Q&A box at the bottom right hand of your screen, and we'll do our very best to cover as many as we can at the end. So with that all being said, Joe, it's a real pleasure to have you with us today. Over to you.
Thank you so much, Joe, and hello to everybody listening. If we move on to the first slide, please. So I'm going to obviously cover the outlook today, and particularly with events in the Middle East, and how I'm seeing things as a result of that, and how the trust is positioned. But I just thought I'd start with some important sort of background pages, just talking about City of London, some of the features which we think are very attractive for investors. As you probably know, our objective is long-term growth in income and capital, and that picture just shows our origins, which actually was originally as a brewery company. And we had a brewery on the banks of the River Thames until about the 1930s. So, but we've obviously for many years we've been known for our dividend growth record and also producing very good total return. And one feature of good investment trusts is an independent board of directors, and City of London has Sir Laurie Magnus as our chairman, who has a long career in corporate finance and is still an advisor with Evercore. But latterly, he's become quite a name because he's also ethics advisor to the Prime Minister. He started that job with Rishi Sunak and carried on doing it under current Prime Minister Sir Keir Starmer. And he gets involved when he has to make decisions on whether ministers have broken the ministerial code. And we've grown to 2.7 billion of net assets, which is the largest in our investment trust sector by some degree. We're in UK equity income sector. And our chairman, Sir Laurie, when we announced our full year results for June year end, so we announced them on 17th of September, and he made two quite important announcements, relating to sort of issues which are quite important as regards investment trusts. And the first is that we've grown a lot over the years through issuing shares at a small premium, typically a premium of kind of 2 to 3%. And occasionally when we fall into a discount, we've bought back shares on a 2 to 3% discount. And by issuing on a premium, buying back at a premium, you do enhance NAV. Buying back at a discount, you enhance NAV for existing shareholders. And we've kind of tightened what we've been doing into a policy. It was previously an aim, but it's now a policy. So we've kind of made a very big signal to the market. We won't let our discount slide. We would buy back on a 3% discount. And, we have in fact carried out this for about 15 years, but we've kind of solidified it into a policy, which I think means that City of London is going to have less volatility in terms of its NAV relative to its share price than the majority of investment trusts who don't have anything like this type of policy, unfortunately. And the second issue on which Sir Laurie pronounced was really on this on paying dividends out of capital, which is what some investment trusts have been doing, and it's something you can do under investment trust structure. We've made very clear that for City of London, other than in very exceptional circumstances, we'll carry on paying ours out of income. And we just think that in falling markets, shareholders won't want some of their capital paid out to them as dividends. They want to see it earned. And so we've kind of nailed our colours very firmly to the mast of only really paying dividends as we receive them from the companies we invest in. I mean, there are exceptional circumstances, and I'll talk a bit more about that in periods where you have a lot of dividend cuts across the market, when we can use our revenue reserve to keep our dividend growth going. But that's the kind of very exceptional circumstances, not normal conditions. Next slide, please. So I've been manager of trust for a very long time. Coming up to, I started in 1991, so it's coming up to 35 years, and it's been a huge privilege. I've done some other things in my career, but it's been a huge privilege to manage this trust for so many years. And I've worked very closely with David Smith for over 10 years, and he was appointed deputy in 2021. And we're both members of the Janice Henderson Global Equity Income Team, and you may know some of my colleagues. A feature of the trust is that we have a very competitive management fee. It's only 0.3% in terms of investment management fee. All the charges come out at 0.36, which is the lowest in our sector, and also one of the lowest, is very low for an actively managed fund. Another feature of investment trust which we've taken advantage of is to have issued some very cheap debt when interest rates were low. So we've issued these two private placement notes, which, as you look at those coupons, which are 2.67% and 2.94%, and this is way low than the government can now borrow at. And we issued those when interest rates were ultra low, and they've secured cheap financing for investment in equities for our investors for the next quarter of a century, which is a real advantage we've got. I mean, all we have to beat is a sort of weighted average of about 2.8% on that borrowed money. And if we can't do that on a per annum basis, obviously it's going to be a very sad old world. Next slide, please. Just a little bit about Janice Henderson. Henderson was the British bit of it, which goes back to 1934. We merged with Janice in 2017. That's been a very successful merger. It's obviously given us a big insight into the US market, which tends to drive things globally, as you appreciate. And in particular, Janice came with them a collection of very strong analysts across and we've really benefited from that. We've, in particular, in the City of London, we've had we have an excellent European banks analyst, and he was a key person who persuaded me to go overweight in the banks 2.5 years ago, which has worked out very well, having been underweight for many years since before the global financial crisis in 2007. Next slide, please. So in terms of my investment philosophy, it is valuation driven. I mean, for me, it's kind of equating the share price valuation with the growth prospects of the company that is critical. And I like to buy sort of quality when it's a bit out of favor. And we might end up selling things when they start to get expensive, or at least reducing them. But we don't operate a sort of deep value philosophy. We do look at the macro factors, which are obviously relevant to, in our view, to companies' growth prospects. And when we start with dividend yield, but we look at a range of share price valuation valuation methods and measures, and in particular, we need to be in companies that are growing their profits and growing their dividends and investing enough for the future. We don't want to be in the high yield value traps, the companies which are, end up probably cutting their dividends and being poor investments. So we're looking for the sweet spot of decent yield and growth. And we do need companies to invest enough for the future, because if they're not doing that, they don't have a long-term future. And then it's a pretty conservative approach. I'm a conservative personality, and so we like companies with good cash generation. Typically, they're best able to both pay dividends and make the necessary capex. And we also like strong balance sheets, especially for cyclical companies. I mean, a mixture of operational and financial gearing can be toxic in a downturn and lead to cut dividends. And we're looking at as much at the downside as well, at downside protection as well as the upside potential. So that's a key factor. It's, avoiding the disasters can be as important as being in some of the winners. Next slide. So this is our long-term performance since I became portfolio manager back in 1991. You can see we're well ahead of the index, and we've also got reasonably good short-term performance. To the end of January, we were up 25.3% total return, which is comfortably ahead of both the FTSE All-Share 21 and both the AIC, which is the investment trust sector, 15.3, and the equivalent OIC sector, which is 17.3. And we're actually ahead of our benchmark, the index, All-Share Index, over 1, 3, and 5 years. We're marginally behind over 10 years by around 2 percentage points, but we are comfortably ahead of both the AIC sector and the OIC sector over 10 years, as we are over 1, 3, and 5. Next slide, please. So in terms of the revenue, we're obviously well known for having the longest record of consecutive dividend increases of any investment trust, going back to 1966. And last year we increased our dividend with Junior M by 3.4% and our earnings per share by 3.3%. But obviously, we do have to have a core of consistent companies. That's important. But in addition, we do use investment trust structures. So during the pandemic, as you can probably remember, there were a lot of dividend cuts across the UK market. 2020, FTSE dividends were down by some 36%. So during that period, we did use our revenue reserve. So the year to June 21, which was the second year of that period, we actually dug into our reserves by 11.8%, as you can see from the table on the right. The previous year it was actually 21%, which was the biggest reserve draw in my 34 years. But since then, we've covered our dividend and we've put back a bit into reserves. So you can see, for example, last year we paid out 98.7%. So that 1.3% would have gone back into the revenue reserve, which grew actually the revenue reserve per share grew by 5.3% in that 12-month period, and provides us a buffer for the future. Next slide, please. So this gives you the very long-term dividend record going back the whole way back to 1966. It shows how the dividend compounds. And actually, as you might probably know, we pay a dividend quarterly, and the quarterly dividend is now worth more than the full year dividend when I started in 1991. It shows you the sort of value of compounding over time. And part of what we do is we do believe in diversification. We don't like having all our eggs in one basket, particularly when it comes to dividends. So you can see we've got a decent spread across sectors. Our biggest single sector for income is consumer staples, followed by banks at 13.3%. Sorry, insurance at 13.9%, and then banks at 13.3%, and then financial services at 10%. So financials are quite a big weighting. Oil comes in at 8.6%. Next slide, please. So let's now talk about the macro, and obviously hugely significant what's happening in the Middle East and the move in the oil price. And I was thinking back to early in my career when I came back from holiday the date was actually 2nd of August 1990, and it's my first day back in the office, and Saddam Hussein and the Iraqis had invaded Kuwait, and it was quite a big shock at the time, understandably, and basically the equities did sell off for the next 4 months, and then in January 1991, the American-led coalition forces swept back into Kuwait and reconquered it. And then, of course, stopped it at the border, and the equities absolutely roofed it the moment the sort of the American forces started going back in. And I think obviously this conflict is different, and but it's obviously the same part of the world, but there are some marked differences. But I think overall it's difficult for equities to perform while the uncertainty persists, particularly with the Strait of Hormuz being closed and the upside potential on the oil price. So, but I think once people are convinced that, well, once we get a glimmer of some light at the end of the tunnel, then I think that equities, will perform well and rebound quite strongly. So it's a question of really the duration of the war, I think, both for the oil price itself. I mean, the oil market is quite oversupplied with oil up until this point, but obviously that's changing with the Straits of Hormuz being closed, and so and the oil price obviously had a big move already. But so I think a lot depends on duration. I mean, President Trump, you feel he doesn't want a long war, and I think he said as much. But it, how he extracts himself from it, the off ramp as they call it, is kind of going to be interesting to see, and how the Iranians react to everything. But so it's obviously it has changed things a bit, and I think it adds the policy uncertainty, which has already came from the US with the kind of various tariffs, etc. And I think up to like the weekend before last, I think we could confidently say UK interest rates were on a downward path. Inflation was likely to hit 2%, and we probably could see between 25 and 75 basis points of base rate cuts this year. But that's probably been put on hold a bit by what happens to the oil price. I'm still thinking. I mean, certainly if we get a short war, then I think I think we're still back on for interest rate cuts. But the longer it goes on and the more the oil price rises, the kind of less certain one can be of that. But I think in terms of UK equities, I very much strongly feel that investors are paid to hold on. I mean, on a yield basis, equities may yield slightly less than fixed interest. The bottom chart shows the various yields that are on offer, and we may yield slightly less than fixed interest and base rates. But of course, with equities, you've got dividend growth, and so you'd expect that to be the normal relationship. It only differed a bit during the period of ultra low interest rates. But I would say that I would expect equities to have a lower yield given the kind of growth you get in both in dividends and earnings from equities. And in terms of the price earnings ratio, which is another basic valuation we look at, it's slightly above the very long-term average, but the UK market looks cheap compared to other equity markets. Admittedly, we don't have such a big technology sector, but which might be a blessing in sometimes. But certainly we compared to our sort of 10-year average PE, we're kind of in touch with the 10-year average, whilst the American market is very expensive and most other markets are more expensive compared to their kind of long-term averages than the UK market is. And I certainly think you have got a combination of a reasonably attractive dividend yield of around 3%, but also you've got a lot of companies are buying back their shares. There's talk of a lack of marginal buyer in UK equities, and with so many institutions investing globally or into fixed interests, and the public the same. And I think as a result, companies have stepped in, and some of our biggest companies like Shell or Imperial Brands have got large share buyback programs. And overall, companies' share buybacks are worth some 2% of the market cap of the UK market. So if you add that onto the dividend yield, you've got a total distribution yield around 5%, which is pretty attractive. And our share buyback yield is higher than the American market. So we've got a better dividend yield and a better share buyback yield. So I think, you are paid to hold on in UK equities. And as a result of cheap valuations, you're getting a lot of takeovers. And we've seen it in our portfolio over the years at City London. We've had 2 takeovers already in 2026. We've had Beazley, which is a specialist insurer, being bid for by Zurich Insurance, and Schroders, the fund manager, has been bid for by Nuveen, which is a US company. So it's 2 classic examples from our portfolio, but there are many others out there. So our gearing at the end of January was 6.5%. The kind of combined Beazley and Schroders holdings, which we have, are worth about 2.5. So the gearing is probably a net 4% because they're kind of quasi cash now. So we're kind of pretty defensively positioned, but those very cheap borrowings, are there for kind of strategic gearing. But we have got bank facilities which could enable us to increase the gearing when we think there's a good opportunity. Next slide, please. So in terms of the overall structure of the portfolio, we've got about 78 holdings. So obviously with a 2.7 billion portfolio, we have smaller holdings for some of the kind of medium-sized companies, but we're predominantly in the large cap. We're 84% in the FTSE. We're and only 9% in the rest of the UK market. But some of the division is slightly artificial between the kind of smaller FTSE 100 companies and the sort of top end of the mid 250. We've reduced our overseas listed proportion portfolio. We were as high as 17% a few years ago. We're now down to 7% because we're seeing so much better value in the UK market. But it does give us some extra diversification in some sectors, like we have Total Energies, the French oil company, in addition to Shell and BP. And in pharmaceuticals, we have Merck of the US and Novartis and Johnson & Johnson, in addition to AstraZeneca and GSK. And then, as I mentioned, the gearing was 6.5%. So in terms of the biggest sector weights, the biggest single weight is banks, where we're slightly overweight relative to the index and we got 16.4%. It's good, 16.1 in the index. Our biggest holding is HSBC, where we're actually slightly underweight. It's a very big index weight. But our kind of main overweights in the sector are rather NatWest and Lloyds, and we're also slightly overweight in Barclays. And that sector we've been very positive about. What our analysts spotted a couple of years ago is something called the structural hedge, which is the sort of balances the banks have, the UK banks, which they are hedged very conservatively on a kind of 5 to 7 year basis. So those hedges taken out when interest rates were very low, as they roll over, they can reset on much better interest rates. That's been a very positive tailwind for the sector. And in addition, I think there has been a sea change in regulation. I think the years immediately after the financial crisis, the regulators, wanted the banks to become safe again, and they had to rebuild their capital. And obviously that was the primary objective of politicians. But now I think the mood's shifted, and what politicians want is growth, economic growth. You don't get growth without the banks lending. So I think you're definitely seeing a situation where the banks are being told they've got enough capital, and it's more a question of kind of enabling them to lend more. For example, mortgage lending has got very restrictive, and they're obviously going to make it easier for young people, first-time buyers, to get mortgages with less restrictions. And then the second biggest sector is financial, what's called investment banking brokerage service. That's the sort of name for it, but it's I better described as financial services. This is something I think the UK does well. We've got some really good companies in this sector. M&G is the biggest, which is a mixture of fund manager and life assurance in our portfolio, but we've also got Schroders in this sector, as well as IG Group, which is a kind of alternative financial markets operator and broker, and then we've got 3i, which is included in this sector, where we've taken some big profits, but the private invest in private companies. And then our third biggest sector is personal care, this is drug and grocery stores. So this includes Unilever, which we've been adding to. They've recently demerged their ice cream business, and we think this is a good move. We sold that part of it, and the rest of it's higher quality. This gives us a lot of exposure to emerging markets. Some 50% of the turnover is in emerging markets, and so we think this is on a better growth trajectory now. But also within this sector, we have Tesco's, which has done very well for us, and it's very dependable, good cash flow business. And in addition, Reckitt's is another important holding in this sector. Pharmaceuticals is our fourth biggest sector. AstraZeneca is our biggest holding. We've got a decent weight in it. It's been very successful. It's not a great dividend payer, so we are quite underweight Astra. It's been successful on the pipeline, but so it is a decent holding, but difficult for us to be overweight given its very low dividend yield. It hasn't got a great dividend growth record. And then oil, we got 7% in. Shell's the biggest holding. We also hold some BP and Total Energies. We've added a bit to BP and Total, over the last week, given circumstances, and obviously this is quite helpful, narrowly from the oil company's point of view. They are quite correlated with the oil price, so they're better placed. We think the sector's in better shape than it was in terms of dividends. I mean, obviously I was very disappointed that when Shell cut its dividend as to BP in 2020, but we think from the base they're at, these dividends are much more reliable, and Shell's also got a big share buyback as well. Total didn't cut its dividend during that period. That's when we initially bought it, and we've kept a decent holding in that one. And then tobacco, always a controversial sector. I'm also not at all in favor of cigarette smoking, but these are very cash generative companies, BAT and Imperial Brands, and almost 100% of profits gets translated into cash, and so these are very dependable in terms of their earnings estimates. Also developing much less harmful next generation products like nicotine pouches, where BAT in particular, and in vaping is the leader in the US. They've got a very strong business in that area. So those leading 6 sectors make up about 54% of our portfolio, and you see advantage of a kind of diverse mixture of companies within that area, but with a sort of slight bias towards financials. Next slide, please. So this makes one very important point. This is our portfolio, although we're predominantly UK listed companies. If you drill down to the underlying sales of our companies, you can see that almost 60% is actually overseas. So around 41% is UK. The rest is overseas with a good spread, 21% North America, but plenty in Europe, Asia Pacific, and emerging markets. So we would argue that you are investing in UK equities, but getting global exposure to global growth at a discounted rating. And then the chart on the right just compares our weightings with the index, our index benchmark. And you can see our biggest overweight is financials. I talked a bit about banks, but we also think there's a lot of value in insurance companies and financial services. So that's the sector we like. The second biggest is consumer staples. That's a mixture of the tobacco and also companies like Unilever and Tesco's. And then real estate's an area we like a lot. We've been adding to, and that's our third biggest overweight. And these real estate investment trusts are standing at discounts of sort of 25 to 30% to the net asset values, which are calculated by professional firms. And we've seen a lot of takeover activity in the sector over the last 12 months. Around 6 UK listed REITs have been taken over by private companies over the last 12 months, which indicates the private buyers are seeing value in the sector, and they're also throwing up very attractive dividend yields. So, we hold Land Securities and British Land, which have a mixture of retail and London offices, but we also have Segro, which is the leading company in industrial property, and also got some exposure to data centers. And in addition, we've bought in the last 9 months, we bought a holding in Big Yellow, which is a big self-storage company. It's a leading in the UK in that, and that's for a very attractive prospect in our view, on a much cheaper rating than you've been able to buy it for many years. In terms of our underweights, they're mainly cyclical, so we're quite underweight industrials, and particularly don't hold Rolls-Royce, which has had a spectacular recovery from the lows, but only started paying a dividend again at a very low level about a year ago. And then we're pretty underweight consumer discretionary, which includes sectors like retailing and hospitality. And of course, those areas have been very badly hit by the Labour government's taxes on employers' national insurance, and also by the minimum wage going up well above inflation. So we're pretty light in that area at the moment. Of course, it includes airlines, which are suffering a bit with the latest problems in the Middle East. And then our third biggest underweight is healthcare, which is primarily due to our underweight position in AstraZeneca, which I've already mentioned. Next slide, please. So this is the final slide before I throw it open to questions. So it's 59 years of annual dividend increases. We actually announced our third interim dividend on 9th of April, which is usually the dividend where we announce an increase in the rate. So if we announce an increase, and it will be the decision of the board, but they've expressed a lot of confidence that they'll be able to. It'll be 60 years of annual dividend increase, which obviously is an interesting mark to have achieved, and we're very proud of it. And that's been achieved through having a core of consistent companies in the portfolio, but also we could only have done it through the investment trust structure, having the revenue reserves in the difficult years like 2020, 21, and to pay out of those revenue reserves in those difficult years, and then put money into the reserves in the good years for dividends. We think our charges are very competitive. They're the lowest in our sector, and at 0.36, they're very low for an actively managed fund. And we've achieved a long-term outperformance of the UK index through a conservative investment style. So thank you very much for listening, and I'd be very happy to take any questions.
Fantastic. Thank you, Joe, on that one. I think that was some really insightful overviews on both the trust and where you and the team are seeing some value in the broader market environment. We've had some really good questions come in from the audience, so I think why wait? Let's get straight into it. I mean, you've touched on it already. City of London is known for its dividend growth record, also its total return approach. So on that, it would be really good to get your thoughts on how you and the team kind of build that income resilience, and really help the portfolio navigate those tougher markets, but also how you traverse a market like the UK, where it is shaped in an income lens, at least, by some fairly big concentrated dividend sectors.
Yes, well, there's quite a lot in that question. Maybe you just go back one slide, please. That's just shows you the discrete performance, which is a compliance slide. Thank you. Yeah, there's a lot in that, but people talk about the concentration in the UK market, but if you look at the US market, it's incredibly concentrated towards technology companies, much more so than the UK, which tend not to pay dividends. So I don't find the concentration is marked as some people make out. In particular, you've got different blocks to it. You've got obviously you've got oil companies, which are quite big, and people think, a few months ago, people might have said they were dinosaurs, but everyone realizes that actually the world is still, oil's actually pretty important for the world. And so it's not a bad thing to have a bit of oil exposure, particularly in times like we have today. And then obviously financials are a big part of the UK index, but then financials are a big part of our economy. And, and obviously the banks went through a really difficult time, during the global financial crisis. But as I've said, earlier, I think they're in much better condition, and we're seeing very good dividend growth from the banking sector. I should have mentioned that earlier. So that's a really good area of dividend growth. And then some of the kind of consumer staples type companies, I mean, these have been around a long time. They tend to be pretty consistent dividend payers. I mean, Unilever, it's incredibly global. It's got a huge presence in emerging markets. Tesco's is our leading food retailer. Almost a third of the UK buys their groceries from Tesco's, and they kept the nation fed during the COVID period, etc. And obviously Tesco had its issues going back, but it's in a much better shape now. They divested a lot of their peripheral overseas interests, and they focused on being price competitive in the UK, and they got their club card, which is gives them a big advantage. It's much more sophisticated than competitors, so I would say they're in really good shape. And obviously, within Staples, Diageo did cut its dividend. We have got a holding there, and so just because you're Staples stock doesn't mean to say you can't end up over distributing and cutting. But the tobacco companies, are very good cash generators, and I'm very confident they can carry on growing their dividends. So, when you look at our top 10, we got some growth stocks in it, like AstraZeneca, as well. And BA Systems, I should mention, is our biggest industrial company, and that's been obviously that is in a really good place at the moment. I mean, given the world we're in, we do have to spend more on defense, and they are a very global company, and their biggest market is America, but they've also got obviously they're Britain's biggest defense contractor. They also got very big interest in continental Europe, and also in the Middle East with Saudi Arabia, and also in Asia Pacific with countries like Japan and Australia. So and then they got we got the mining sector again, which is that's been quite volatile for dividends. I mean, our main holding, Rio Tinto, has actually been the best dividend pair, but the world needs it may seem a bit old-fashioned, but actually all this electronics and data centers. I mean, we're going to need a lot, and electrification. We need a lot of copper going forward, and we also need iron ore to build things, etc. So I mean, the commodities that Rio Tinto and Glencore, which is the other holding in that sector, produce are pretty fundamental to kind of economic growth and modern life. So I don't find I find there's plenty of diversification in the UK. We got a small technology sector. We hold Relics, which is now classified as a technology company, as a software company. It's got some incredibly high quality business information, and analytics, as well as providing information for insurance companies and legal firms, scientists, etc. And I think it's a very high quality. We also got some Sage as well, but it's a small sector in the UK market. So I would look at other markets and say they've got their own concentrations. Obviously, you want exposure to technology, or want a global technology fund, or American, or a fund invested in the American market, and that will complement City of London very nicely. But we don't. I definitely don't see us over concentrated in terms of income at all.
Fantastic. Probably unsurprisingly, Joe, we've got a few questions that have come in around, the current backdrop and what's happening, both on the kind of geopolitical tensions front, but also some escalating conflicts in the Middle East. And it's always an odd one, isn't it? Because thinking about money in that kind of period feels ethically unimportant, but it's clear that the conflict in Iran and things that have stemmed out from Ukraine will impact markets. It's almost inevitable. So I guess in the context of the UK, you've touched on oil already, but what do you see the impact being, both over the short run and perhaps an even harder answer, I know, but also the long run impact as well?
I mean, it's a good question. I must say, one's thoughts do go to everybody out there in the region. Actually, my daughter was flying home from holiday from Australia and flew into Dubai on the Saturday, and of course couldn't fly out on the Sunday. Unfortunately, she did manage to fly back home on the Wednesday. So it brought it home to me very much. Just all the people out there in Dubai and the whole region. Yeah, in terms of I mean, as the thing I said in the presentation, the old up until now, there was actually an excess of oil out there in the world relative to demand, and there are some sort of features, for example, which are affecting demand, such as the growth of electric vehicles, which may have stalled a bit in Europe and US, but in China has grown at a pace, and as a result, Chinese demand for oil has been, which has been one of the big growth factors behind oil demand over the years. So it's actually slowed down significantly. But this obviously changes everything. And I mean, there are other areas. The world isn't quite as dependent on Middle Eastern oil as it was back in the 1970s. And Saudi Arabia has now got a pipeline which goes east to west, and means some of their oil, they don't have to go through the Strait of Hormuz, but it still is a critical pinch point for the whole world oil sector. So the longer it lasts, I mean, the more the oil price is really going to go up, has to be said. And also, it's pretty important for liquefied natural gas, which is produced in great quantities in places like Qatar, and that a lot of that passes through the Straits of Hormuz. And so I think it is a concern. The longer it goes on, and oil is pretty fundamental still to the world economy, not just transportation, cars and airplanes, but also electricity generation. It's very important in many countries, particularly liquefied natural gas, and also the whole plastics complex, and fertilizers, so on and so forth. So it's pretty important, oil and natural gas in the world economy. So it does have a kind of stagflationary impact. Both adds to inflation, and also but also acts like a tax on consumers, and it will and it will kind of reduce demand for other things. And that's what we had in the 1970s. You had both high inflation and very, very low growth, and all kind of economies not growing. It was kind of termed stagflation. I think that's when the term got invented during that period. And so it's not good news at all. In addition to the kind of all the many other sad aspects to what's going on. So the longer it goes on, obviously the more negative it is, really. But as I said, I think stock markets are discounting mechanisms, and
Yeah.
the stock market today will be reflecting all those worries, and the gilt markets reacted very quickly, and other bond markets, in sense of they were anticipating interest rate cuts, and they've now put that on hold, and that's meant gilt prices have declined and gilt yields have gone up, as with other bonds. So all of this gets, so I think the key thing, and I go back to 1991, once the kind of market gets to see a bit of light at the end of the tunnel, then people will stampede back into equities. And so it's a balancing act, and it's obviously nobody knows quite when that turning point is going to come, particularly when you've got quite a mercurial president of the United States like Donald Trump. He quite likes it's like sort of game show host, isn't he? Quite likes kind of teasing people and surprising them. But obviously it's all deadly serious what's going on, and we just have to watch it very closely. And I mean, as I said, Citi's portfolio is pretty defensively positioned, and we got no exposure, very little exposure to sort of airlines, and consumer discretionary is very light in cyclicals generally. So we think the portfolio is decently positioned, but these sort of periods, that it doesn't stop the whole market getting dragged down for a time. But in the long run, equities rebound, and it could be over sooner than we all think. But it obviously it is continuing as we speak today.
Completely agree. And I guess another big recurring theme for markets, and even though the UK's tech sector isn't, as comparable as the US, but AI, that seems to be a topic or a debating subject that you can't avoid at the moment. And we've already seen a number of SaaS companies, or the kind of clean data proprietary companies, be hit by fears over AI. And I wonder if you have any thoughts, you and the team have had any thoughts on areas perhaps elsewhere in CTY's portfolio, like financial services or banks, given their good absolute positions, that might be equally vulnerable, or indeed, on the other hand, offer opportunity.
Yeah, I mean, this was the hot topic before the Middle Eastern war erupted, and has been for the last year. And the sums of money, the backdrop is the sums of money being spent by the so-called US hyperscalers, the kind of six big US companies to it. It's just astonishing. I mean, they are spending this year $600 billion they've earmarked for spending on AI and data centers. And I think a lot of people are questioning just whether they're going to get, what kind of return they're going to get from this. And I think that part of it is, to justify this sort of expenditure, you've got to think of all these sectors are going to lose a lot of money, from going to get wiped out. And we can all remember, with the internet, for example, there was a stock called Yell, which was the kind of yellow pages, and that got completely killed by Google, and eventually went bankrupt, had a bit too much debt. But in the end, going back, we all used to use yellow pages. Once we had Google on our phones or whatever, there was just no need to use it, and its business was totally destroyed. And people are thinking, where it could happen again. But I have to say, I just think some of the software companies have got much better moats around their businesses than is commonly perceived. But there is a bucket, hedge funds are betting on buckets of AI losers, and a couple of our companies have been caught in it. I mean, Relics, which I talked about earlier, but we think a lot of their data is proprietary. We've met with the chief executive since our annual results a couple of weeks ago, and we've actually added a little bit to our holding. This stock, with a bit of hindsight, it got too expensive 12 months ago, but the shares are almost halved, and yet the profit estimates haven't changed. They're still going up, by 10%, and we just think this has got a much better business model than it's been given credit to. So we think, you've got to be careful because the market has a certain momentum, and as the economist Keynes said many years ago, the market can be irrational longer than you can be solvent. So you've got to be, I'm not arguing it's going to change short term, but Sage is another one we have which has been hit in that area, which provides accounting software for kind of small businesses, and that game we think it's got a very sticky customer base. And then we've also added recently, we bought a holding in Rightmove, which is the leading property portal, and that their shares again have been very poor, and they're the dominant property portal in the UK. 90% of estate agents subscribe monthly to Rightmove, and it's a very profitable company with 65% operating margin. And the British, as we all know, are quite obsessed with property, and apparently the population, about half the population, looks at the Rightmove website every 2 months at least. So and yet I met with the company recently, and they argue they're providing a lot of proprietary data to the estate agents on buying patterns and that type of thing. And again, I think they've got an entrenched business model. Only time will tell. But only 18 months ago, REA of Australia bid for the company some 50% higher than the current share price, and the board turned the bid down, thinking it was too low. And it's certainly one that brokers in the market talk of as a takeover candidate. But it looks it's derated down to a P of about 15 times, 2.5% dividend yield. So it's much more reasonably rated than it was.
And I guess on valuations, Joe, it's a bit of a cog turner for a lot of investors, but clearly CTY is predominantly invested in those larger UK companies, but there is a small allocation, 10% or so in the kind of mid-cap space. And the dynamic there, you're looking at lower valuations compared to some of the larger companies, but also overseas peers. And usually the yield is very attractive, and that growth potential is also very attractive. But that segment of the market, aside from a few specific stocks, seems to struggle to really turn sentiment and re-rate as it probably should do. What do you and the team see as perhaps catalysts for that part of the market to really start to meaningfully re-rate and match the kind of fundamentals that they're offering at the moment?
Yeah, you're absolutely right to raise it. And Dave Smith and I, several years, been kind of trawling around in the mid 250, trying to find attractive opportunities for City. And it is a remarkable period because actually the FTSE 100 has now outperformed the rest of the market 5 years in a row, which is the first time it's ever done that. The FTSE 100, I think, was created in about 1985, and it's kind of never done that before. And I think the best it ever did was like 3 times at in the 1990s. But it is so obviously as you say, unusually dividend yields are slightly higher in the mid 250 than they are in the 100, which is quite unusual as well. And so we're trawling around. We're just struggling a bit to find companies of the quality, particularly from an income point of view. I think although the overall yield might be slightly higher, there've kind of been more dividend cuts. Been a lot of dividend cuts in that mid 250, and it's got a lot of UK domestic, and some of those sectors that have been worst hit by the Labour government's increase in national insurance, large employers like hospitality or retailing, they can be found in the mid 250, and so we're just kind of struggling a bit to find the companies, the quality we really want for City, but we're not giving up at all. We're still sort of and one we've bought actually in the last month, which is now a mid 250 company, is ITV, which I think looks very interesting. It's something in a special situation because there are 2 parts to ITV. They've got the broadcast business, which is still our largest free-to-air broadcaster, and then you've got their studios business, which is one of the biggest studios businesses in the world, which has got good growth. The studios has got very good growth prospects, whilst the broadcast business is kind of more cyclical, and obviously is hit a lot by the amount of pay TV or streaming you can do these days. But as you probably know, Comcast, who owns Sky, are in discussions to buy ITV. And there's a lot of industrial logic about putting those two businesses together, a lot of cost savings to be achieved. On the other hand, there are competition issues and it could get stuck with the regulators. So nothing's been, it's been announced here in discussion, but there's no agreements been announced. But if it was to happen, I think there's upside of over 20% from the current share price of ITV, and it would leave a very interesting studios business on its own. But of course, this year is World Cup year, and that is a great benefit because it's on free. The ITV share it with the BBC, and that comes every 4 years. But that is a very helpful tailwind for ITV this year, and particularly if England do well. Obviously, they get a huge viewership for the latter stages. So that's one in the mid 250 we've added to recently.
Fantastic. And I think we've got time, Joe, just to shoehorn one more question in, an interesting one, actually, I think. What are your thoughts on the reduction of the cash ISA allowance, and perhaps where do you see some of the additional stocks and shares capital potentially going?
I don't really have a strong view about it, but certainly when PEPs came in, which were the precursor of ISAs, it was originally just for equities. I think there was a view at the time. I think it came in when Nigel Lawson was Chancellor under the Margaret Thatcher's Conservative government. But I think it was a view that you should be you get the tax advantage for taking a bit of risk, and for kind of investing for the long term rather than just being in cash. But I think when Gordon Brown was Chancellor, they changed into ISAs and they allowed cash in, and also I think overseas equities, which weren't allowed initially. But I don't really have a strong view, to be honest. I think it's not really slightly above my station to pronounce on it, but I'm very confident that City of London, we're providing dividend growth, and which we've done for 59 years, and also total return, and with a decent dividend yield, which on our shares compared to most compared to overseas equities, for example. So I'm confident we've got a good place, whatever the regime is. So I think that's all I'd want to say on that one.
Brilliant. Thank you, Joe. And I think, to be honest, that really neatly brings up and wraps up all the discussions that we've gone through today, and really appreciate your kind of perspectives and thoughtful answers on the questions that have been submitted by the audience. And I guess for those of you still with us and would like to explore a little bit more on the trust in a bit more detail, then Job and the team at Janus Henderson publish a really good wide range of materials on their website, both trust specific, but also broader market insights as well. So I definitely encourage you to go over there and have a look at that. And a really big thank you to everyone who's joined today and who's provided those questions for Job and I. I think it's been a really interesting discussion. And of course, Job, thank you so much for sharing your insights on those. It's always a pleasure to have you on a webinar like this and providing your unique insights, I think, to the UK market and what it offers investors.
Thank you, Joe, and thank you very much, everyone, for listening.
Fantastic. Well, yes, so that does bring us to the end of today's webinar. And we do hope many of you will be able to join us for the rest of the webinars for the ideas of your ISA series over the coming weeks, including one that you might have missed, which is the Schroeder Oriental Income Trust, which we've got in on Tuesday, the 31st of March. But with that, we hope to see you again soon. Take care and goodbye for now.
Goodbye.